And this was the moment when, if you look at the name of our company, AdalFi. So what does this name mean even? So Fi obviously is from finance. Adal, that word in Urdu, which is my language, means justice.
Yes, amazing.
So it's really about equal access to credit. And this was that moment when I felt, yeah, this is now this is
Done
equal
it.
access to it. We've done it.
Yeah. Hello and welcome to 11FS FinTech Insider Spotlight. I'm David Barton-Grimley from 11FS, and in this show, we shine a spotlight on the best and the brightest in the tech and financial services industry to get to know them, their businesses, and what they think the future of the industry will look like. On today's Spotlight, I'm delighted to be joined by Salman Akhtar, CEO and co-founder of AdalFi, a company that's redefining digital lending by helping banks and financial institutions unlock instant, AI-powered credit decision, loan disbursement, and recovery for their customers. How are you doing today, Salman?
Very good. How about yourself?
Yeah, very good. It's great to have you on board.
Lovely day here in London.
Yeah, beautiful. Great day to do a recording. I think it's fair to say that access to credit has long been a privilege, not a right. Yet it remains one of the most powerful tools for social mobility. Traditional credit scoring models have excluded millions from the global formal financial system, reinforcing economic barriers rather than breaking them. So today, we're exploring how AdalFi is pioneering a fairer, more efficient lending ecosystem. So on that note, Salman,
Sure.
Before AdalFi came along, what was a typical experience in Pakistan for someone applying for a loan?
Sure. So the typical experience was long, protracted, and highly opaque. Most people, it would take them about 2 weeks before they would find out whether they qualified for credit,
Wow.
whether it was a credit card or a car loan, whatever. And essentially this time period and the unknowing of that, the fact that, till the very end, you had no idea whether or not you'd get credit, was extremely stressful for people. And also meant that the vast majority of people really wouldn't even bother because it just took too long, too painful.
Wow, that's incredible. And what would you see is the root cause globally? Because it's not just Pakistan that has these kind of problems.
Sure. So the root cause globally is that most countries in the world don't have credit scoring that they can rely upon. And in the absence of credit scoring, especially when you talk about consumer and SME credit and the S part of the SME, banks have felt traditionally that they needed to essentially establish your bona fides. So they would want to go visit your employer, they would want to go visit your residence. Now, all of these things have two problems. One, it takes time because they literally have to go visit.
Yeah.
And secondly, it costs money to do all of this, which means that banks are really not very motivated to lend to anybody except those at the very top of the pyramid.
It's very expensive for them to do it, right?
Absolutely. The origination costs are kind of out of the roof.
Yeah.
And by the way, so one way banks would address that is by having non-refundable application fees. Now, that's another downer, because you're like, hey, I want like $50, $10, $20. And even if I get denied credit, I'm not going to get it back. So all of these are reasons why it was very difficult to get credit in Pakistan and in many other countries like this.
And doing that just excludes so many people from the financial system.
That's right.
I mean, if you reflect on all of the innovations that have happened in fintech and FS over the last few decades, you see Europe, you see America, you see Southeast Asia, for example. Why would you say it's taken so long for incumbent financial institutions to start taking on this tech?
Well, if you look at lending specifically, and really, as you know, the global financial industry is kind of, from a consumer perspective, has got these two pillars. There's payments and the innovation that's happening in the payment space, which of course has now been, there's a lot of things that have been happening. And then you look at lending. Okay, so lending has traditionally had this problem where banks have either been way too aggressive, which means, literally distributing things like credit cards, like confetti, or been way too conservative, and that means really essentially denying everybody credit. Now, one way to think about this really is that the banks have not really figured out how to solve the cold start problem. You know how many networks have a cold start problem? So lending also has a cold start problem, and the cold start problem in lending is this. How do I lend to you the first time?
Right.
You see, after I've given you a loan and after you've had 1 or 2 loans and you have a repayment history and I can score your repayment history and say, oh yeah, this person keeps on repaying their loans, they're good, or they don't, they're bad, whatever it is. So that's okay. But the cold start problem, how do I lend the first time around? That's a hard problem. And by the way, this is not just Pakistan or the third world or emerging countries. Even in the US, for example, it is a problem. In the US, this is referred to as the thin file, no file problem.
Yeah.
You don't have a credit file, and how do we score you? So this is really the base problem that banks have really struggled to grapple with.
That's fascinating. And when you sought to set up and found AdalFi, was that the eureka moment for you?
Absolutely. The eureka moment was that, okay, you have a cold start problem. Now, just to put this in perspective, Pakistan, for example, has about 65 million bank accounts. So it's a big country, 65 million bank accounts. But if you count the number of credit accounts, and that includes all credit cards, all car loans, personal loans, home loans, you're talking about something like 4 million out of the 65 million. Wow. So you've got 90+% of the people who do not have access to credit. And really, it was this problem that we saw, that we thought that we could address.
And you can see the scale, right, in solving that problem.
Oh, absolutely. The scale is massive, and the scale is true pretty much for any country in the world, wherever you go out. And the scale is true on the consumer lending side of the house as well as the SME side of the house.
Absolutely. So we've discussed some of the failings of the old system. How do you do it differently?
Okay, so let me talk a little bit about kind of what they do and what is it to kind of contrast what we do. So if you look at what the traditional credit scoring does, is it focuses on what I call the macro structure of lending decisions. Now, what does that mean? That means, for example, taking into account the number of loans that you've had, your repayment history, the amount of credit that you've used. This is, in a sense, kind of the big picture view of my relationship with all of my lenders. Okay, so that's the macro structure. We really focused on the microstructure. So the microstructure is what's really going on in your financial life. The macrostructure is also important. We do take that into account. But the microstructure is, for example, what is your salary?
Right.
How do you spend your money? What do you spend your money on? Okay. So the microstructure gives us a much more detailed look at how people are really living their financial lives. There's another thing that we do which is very different from what traditional credit scoring does. So traditional credit scoring is essentially a lagging indicator. Yeah. So what that means, for example, is that let's suppose I have, let's say I have 3 credit cards out, I'm good on my repayments, etc., but I've lost my job. But I still have some money in the bank and I keep on making my repayments. My credit score is going to remain constant because I'm making all my repayments. Very good, no problem here. Whereas the bank and the lender really doesn't know that actually I'm headed towards financial distress. So it's a lagging indicator. Whereas when we look at the microstructure, what's really happening in your bank account, it's a leading indicator because it tells you, hey, this person is getting money or they're not getting money, and how they're spending the money. So it's really these two things that are very different from what we're doing in what we're doing.
Yeah, and we have similar problems in the UK with the electoral roll, for example, which only updates like once a quarter or once every 6 months or something like that. So as you say, it's everywhere in the world.
That's right. But even over here, like, even in the US, for example, if you consider FICO, right, which is, so FICO is based upon, all of your repayments. So FICO has no visibility into what's really going on in your financial life because they have no access to that kind of data. And they've chosen not to take a look at that data, at least so far. So that's really the distinction that we've drawn.
That's very interesting. And was there a data point when you were building these new models, was there a data point that you came across where you can say, okay, that makes a difference?
Sure. Well, it's a little difficult to answer that because obviously some of this is proprietary to what we do.
Yeah.
But I'll give you a really simple, on the face of it is a very simple example, but it shows kind of the complexity in scoring. So for example, if I wanted to give you a loan, I'm a banker, I want to give you a loan, and I'm looking at your bank account. One of the things that, intuitively makes sense is, hey, over time, is your balance going up or is it going down? Is it kind of steady, right? And it seems to, make sense as a question. But when you look at the actual details of it, turns out it's an extremely difficult question to answer. Because there's all kinds of weird stuff that's going on in people's balance, especially you start looking at it on a daily basis. It's kind of going all over the place. It's moving up, then it's moving down. It's kind of ramping up for a couple of months and then suddenly going down. So even things like, hey, what's the trend line of your balance turns out to be an extremely complex question to answer. So one of the things that we really worked on is we've tried to kind of sort of balance between two extremes. So one extreme is where you say, okay, you're just asking like really simple questions about you as a person, which is what people do when they don't have any other data to look at. So they'll say, okay, what kind of company do you do a job in? What's your educational qualification, et cetera? Because they're trying to make a sense of, okay, where do you fit in kind of in society in general? And that's kind of the thing that really leads to a lot of bias in lending, because a lot of those questions kind of prefigure what the people who made up those questions think a good borrower should be. So that's kind of one extreme, and it's a really bad extreme that we don't want to go towards. There's another extreme that says, you know what, we have 1,700 variables that we score you on. Well, you have 1,700 variables, but how do they actually relate to your ability to actually repay a loan, right? So we've tried to kind of come up with a balance where the variables and the models that we use should be at least explainable to ourselves. We should be able to understand them, right? So for the most part, they're really designed for that. Of course, there's some parts of it which are kind of more on the AI side, where it's really just kind of correlations, and it's hard to sort of have explanatory power about them. But that's the general thing. So as it turns out, when you're trying to do credit scoring, in a sense, what you're really asking the question is, what is this person going to be like over the next 2, 3, 4 years? Now that, definitionally is a hard question to answer, okay? So that means that anything that you look at in trying to answer that question, especially when you go into the detail of that, really kind of blows up. I've had this experience where the same question about balance, I've asked bankers, hey, so what do you think, how should we score in terms of, your end of day balance? And they say, oh yeah, you know what, we look at the starting balance, we look at the ending balance, and we say, okay, has it gone up, has it gone down? And then I'll show them examples of, anonymized data and saying, look, this is what it actually looks like in practice. And it's shocking for them because they haven't seen the data visualized like that.
Yeah.
So they say, oh, I don't know what to do with this. That's right. You can't, if just looking at it, you cannot figure out what to do with it. And that's why you need the algorithms, and that's why you need kind of the hard, deep tech that we've tried to build over the last 3.5 years.
And balancing the macro data with the micro data to create the right kind of mix of decisioning, as you were saying.
And this thing that I just talked about bias, this is also, I think, very, very key. In a sense, of course, all credit models have to be biased, because the bias is they want to you want to identify good borrowers,
right,
and kind of filter out bad borrowers. So that's a good bias to have. That's really what the model is designed to do. A bad bias is where just because you have a certain lifestyle or you didn't have a university degree or whatever, it's kind of scoring you out and kicking you out. Now that's a bad bias, right?
Yeah, absolutely. And would you say, is there a typical customer profile that tends to get excluded from the financial system, or maybe profiles? I guess there's all sorts of different demographics of people.
Absolutely. If you across the world, the people that are easiest to score and hence get the credit the easiest are people that have good salary jobs from large corporations. Okay, to the extent that, for example, in Pakistan, banks would literally rate your employer category A, B, C. And A would be large companies, and B would be kind of middle companies, and everybody else is in C. So that's an example where you have a situation where the vast majority of the people who are not working for these A or B companies find it hard to get credit. And then you also have, look, a lot of this country and a lot of every country in the world is actually the SME sector.
Yeah, absolutely.
And the S part of the SME sector. Now, these are people that actually find it impossible to borrow. I'll give you a statistic. In the US, the most sophisticated credit market in the world, 35% of all SMEs report that they had to use personal credit cards to access credit for their business.
Wow.
Okay, so that's the US, 35%. Okay. in Pakistan and in many other emerging markets, if you are a small business holder and, you go to the bank, you kind of muster up the courage to go to the bank. Because, by the way, nobody likes rejection. Nobody likes being told no.
Yeah.
So you muster up the courage, or you kind of really need the money. You go up and or you think you've got a great business plan. You go up and you say, I'd like to borrow some money. And the bank says, oh, great. Please, show me your financial statements and your financial projections for the next 3 years. Like, what?
Yeah.
I'm a small business. What do you expect?
I'm running a grocery store.
I'm running a grocery store.
Yeah.
What's my 3-year P&L?
Yeah.
Forget it.
Yeah.
So, yes, the vast majority of small businesses, pretty much everybody who's not a salaried person, and by the way, there's all kinds of people that are in that category: gig workers, professional work employees, people who do professional work, etc. And then people who were working for smaller companies. All of these people were really denied credit because it was just easier it's always easier to say no than to say yes.
And that's most of the economy.
Yeah, absolutely.
Is there a story that you've seen of someone maybe you've impacted positively?
Sure. So this is kind of a really moving story. So with one of our banking partners, and we ourselves don't lend, we work with our banking partners. So we launched an SME product, and this was a running finance product where you'd get a limit, and then you could draw down that limit as you felt. So we launched the product, and this is towards the end of 22. And the bank sent out a message digitally to everybody that was pre-qualified, because it was to their existing account holders, people existing, So there was about 4,500 people that had been qualified. So there was this person who was in Gilgit, which is the small town way up north in Pakistan. And they got this message saying, hey, you're pre-qualified for a loan. And, they said you're pre-qualified for the equivalent of about $10,000. And that's, not an insignificant amount of money.
Yeah, it's huge.
So they went to the bank branch, and they said, because they'd gotten an SMS, and they, this person went to the branch manager and said, hey, it looks like, your SMS is getting hacked because I'm getting these crazy messages that I can get a loan. So the guy says, no, this is real. We've actually just launched this program, and if you got this message, you probably can. So he says, really? So he says, yeah. So he says, okay, I'd want to try it right now. So, he sits down and, applies through it digitally through the mobile app, gets the next 10 minutes, he gets his credit approved, and then he draws down about, like $1,000 from that credit limit, actually moves it into his bank account. So, tests to see that the money actually hit his bank account.
Is this real?
Is this real? I actually got the money. And he gets the money and he kind of walks away. So that's great. And then about a month later, this guy, he drives down about 1,000 kilometers and comes all the way to Lahore, which is where this bank was headquartered, and shows up at the bank headquarters. And he says, I want to meet the lending team. These guys say, well, okay, we already gave you the loan. We actually approved you the loan. So, what do you... So the guy says, well, actually, I drove down just to say thank you. Because I never thought that a bank like this would give money to somebody like me.
Yeah.
Because this guy was basically a wholesale dealer for pistachio nuts and almonds and what have you. So not a recognized business, not a this big, brick and mortar kind of business, but, a great business. I mean, the financials were amazing. If you look and they were reflected in the bank account. You could see the transactions flowing. So it was a beautiful story.
That's amazing.
He comes in, they all take pictures and so on.
I love that. Yeah, 1,000 kilometers.
Absolutely.
And actually, that is an example of a business where cash flow is so important. So if you're able to provide working capital to businesses like that, then they can scale and they can grow.
Right. And this was the moment when, if you look at the name of our company, AdalFi. So what does this name mean even? So Fi obviously is from finance. Adal, that word in Urdu, which is my language, means justice.
Yes, amazing.
So it's really about equal access to credit. And this was that moment when I felt, this is now this is equal access to, we've done it. Where somebody that honestly, a person like this would generally think twice even about opening a deposit account, just because, banks have this kind of marbled kind of floors and this aura about them. A lot of people don't feel comfortable even walking into a bank, because it just feels that this is not for me. This is for somebody else. this is not for me.
Yeah.
And for that person to actually be lent money is like kind of an amazing
Keeping
moment.
cash under the bed.
Yeah.
And tell me, how have you, I mean, just looking at some of the stats on AdalFi and what you've been able to do, the default rates are incredibly low.
Sure.
How have you managed to do that?
So, good question. And really, that's kind of at the heart of what we do. So just to kind of put some numbers out there. So we've been around for about 3.5 years. Our banking partners have now lent more than $100 million using our lending platforms. We've given out more than 300,000 loans. And we give out loans of all kinds. So there's SME loans, like this $10,000 loan that I was telling you about, but also consumer loans like credit cards, personal loans, typically in Pakistan, about $1,500 in size. And then shorter loans like, like 1 month short-term loans, etc. So we've now been doing this for 3.5 years. We have loans that have a vintage of 2 years, 3 years. So we also have data. It's not like we just, lent out 2 months ago and we're saying, oh yeah, we have no defaults.
Yeah.
So we have a history of lending out. And really at the heart of it was two things. One, as I said, that microstructure understanding of people's actual financial situation. So not just looking at that big picture, but really zooming in into kind of what's going on. And essentially what happens is that when you score somebody's bank account, generally deposit accounts are very sticky. We don't really change our deposit accounts very frequently.
That's right. It's the same here.
It's the same everywhere in the world.
Yeah.
I mean, like I've had an account with Bank of America for going back 25 years.
Right,
it's like, why change it?
Yeah,
What's the reason?
there. Yeah.
It's there.
Yeah.
Right? So you, first of all, when you score based on bank data, you have a lot of data going back 2 years, 3 years, 4 years. You can go back as long as you want. Typically, we do about 2 years because after that it becomes a little, out of date.
Yeah.
So first of all, you have a lot of data that you can score upon and understand that behavior. Secondly, you can do comparators against a much bigger population because you have all the other people in the bank who are also, deposit account holders.
Yeah.
So that's one side of it. The second side of it is that because we've really worked with banks to, first of all, to lend to their existing customers, because, you've got 95% of your existing customer base does not have loans, so why go anywhere else?
Yep.
But then the products that they set up, and we work with them, and we also provide the tech to actually kind of link up with their systems, actually give out the loans, etc., means that we can also take the repayments back automatically.
Right. Okay.
Because it's it's an existing
from the same account.
It's from the same account, right?
Yeah.
So it just gets done automatically and so on. And then if the money is in there, then you can put on like holds in the account so that actually when the money comes in, it first gets the loan gets repaid and so on. So with all of that, with the modeling, the microstructure details, the fact that it's on your existing liability account, so it's easy for the bank to get the repayment out. It's all automatic. You agree that you will be automatically deducted. You don't have to actually repay because it'll just get automatically deducted. So we with all of that, we have a 0.2% default rate.
Right. That's incredible. Yeah, and I guess you're always optimizing the system.
That's right. But you know what? So here's the funny thing. To convince banks to actually use our scoring model, and especially to convince CROs, right? Because they had their own model, which was whatever they were using, which we had a lot of disagreements with. But anyway, they had their own model. For us to convince them that they should use a model, the one thing that we did, which really kind of allowed us to kind of get past that, was that we do risk sharing with the bank.
Oh, interesting.
So our revenue model is that we do a rev share.
Nice.
But we do an equivalent risk share. So we have serious skin in the game.
You've got skin, yeah.
Yeah, absolutely. Now, one result of that is that our consumer lending model is now on its 3rd generation. And our SME lending model is also on its 3rd generation because we are highly incented to actually improve the models, because we lose money. We actually lose money when loans go bad. Unlike most credit scoring agencies, which it's a one-off, hey, I scored you,
right?
It went bad, sorry, too bad. Okay.
Yep.
So we're really looking at the data very, very, very closely because we've got money on the line.
That's such a fascinating model. And tell me, on that base, Are you planning on expanding beyond Pakistan?
Absolutely. So the first thing that we did when we launched this was because Pakistan was home base for us, we wanted to establish, look, can we scale this as a business in Pakistan and scale this without losing our shirts on losses and defaults and so on. So over the course of the last 3.5 years, we feel that we've established that proof point, 100 million plus in lending. This year alone, we'll do another 150 million in lending. So we've been tripling our gross loan volumes every year for the last 3.5 years. So once we'd established that, we feel that this is now tech that we can take to many other parts of the world.
Yeah, fantastic.
I went to Singapore FinTech Festival in last November, and one of my goals was to really look very carefully and see who else is doing something that's similar to what we're doing. I did find one company that was doing what I thought was very, very close to us. That company happened to be called AdalFi. So I figured,
yes.
okay.
Small company.
Small little company called AdalFi. So I figured that if that's the only company that's doing this, then we've got something that's pretty unique.
Brilliant. It's a fantastic ambition. And tell me, maybe the final question, just to close. I mean, do you see, as you scale internationally, institutions, governments really thinking about access to credit as becoming a right, like a fundamental human right?
Absolutely. So one of the areas where essentially every country that we've talked to and gone into, and we've looked at Bahrain, we've looked at Saudi, Malaysia, Indonesia. SME, for example, is one area where it is on everybody's radar. That we don't have enough SME lending. Okay, that's literally, as I said, true in the US also. But across the world, we don't have enough SME lending. So that's one area. The second area is also, like I said, over the last 10, 15 years, 20 years, with the rise of microfinance, one of the good things that happened with microfinance and with the rise of nano lending, telco-driven nano lending, was that the bottom of the pyramid in most countries actually has gotten some access to credit.
Yes.
So for example, I'll give an example. In Pakistan, the two big telcos are now lending out what is the equivalent of around $10. So nano loans for about $10, typically for about 2 weeks, 3 weeks, that kind of tenor. Okay. But they're providing them to a big customer base,
right?
20, 30 million. Okay. That's great. So you solve that problem. One level above that is microfinance. So microfinance, as you know, in most countries has done very well.
Yes.
It has its own challenges, but at least they've done the lending out, right? But microfinance generally was meant to target people who didn't have bank accounts.
Yeah, right.
Now you've got that leg of that tier above it, which are people who do have bank accounts, so are considered financially included by everybody, by the World Bank, Gates Foundation. Everybody say, oh yeah, they're financially included. Don't have access to credit.
Right. Yeah.
And that's the area that I think will be the next frontier where governments will wake up. They already understand that in the SME space. But in the consumer space, they'll wake up and say, oh, you know what? We've got to address this area. Because this is the area where really people need that credit and can repay a significant amount of a loan, like a $1,000 loan, for example.
It's that emerging, growing middle class all over the world that is still lacking access to these tools. Right, fantastic. Okay, everybody, it's coming to the end of the show. Thanks to Salman for joining me. Where can people find out more about you and everything you're getting up to? AdalFi.com, AdalFi.com. Nice and simple. Right, that's all we have time for this week. Make sure you follow 11FS on LinkedIn, Twitter, Instagram, and TikTok, all the social media channels, to stay updated with all the cool stuff we're doing. And if you enjoy our show, do subscribe to the 11FS YouTube channel, where you can also catch up on previous episodes. Have a great week, everyone, and goodbye.